It is going to be a busy day from earnings to a Fed decision. 30 minutes until we start your trading day. I'm Dani Burger. Matt Miller is still off. Bloomberg Open Interest starts right now. Coming up on today's show, SK Hynix sets the stage for a big day for tech earnings. Microsoft and Meta take the spotlight next. To hike or to hold, markets see a growing chance of a surprise from the Federal Reserve today. And Middle East tensions flare up again. Oil jumps as President Trump threatens Iran with new strikes. So maybe we're a little bit more tepid with what tech stocks are going to do today ahead of the earnings. Microsoft and Meta, they will have less of a high bar maybe because they have sold off over the past month. Still, it's clear that expectations are really high in general. Higher AI spending is going to be closely watched, and often that's met with disappointment on Wall Street. SK Hynix, the perfect example of this. Shares are down after reporting a six-fold jump in profit. However, they also hiked their spending plans by 50%. Let's discuss with Bloomberg Tech host Ed Ludlow. Ed, this really feels like the nature of things now that you can report a more than 550% surge in profits from the year prior, and yet your shares get beat up.
Well, the profit number was still seen as a little bit disappointing, which shows you the severity of the memory bottleneck and the pricing situation on the DRAM side, but also takes into account that SK Hynix has 60% market share in HBM going into data centers. So maybe there were those even more bullish on the street that felt they could have done better. What's interesting is the Capex commitment, right? It's being interpreted. The ADRs are not actually that much lower relative to South Korean trade. But there are loads in the market that say, is that not a really robust signal of confidence in future demand from a player in an industry that has, for a very long time, been super conservative about investing into cycles? So it's a real mixed bag.
Even so, isn't that quite instructive, both from the reaction of SK Hynix and what we got from Alphabet last week to what we're likely to see from a market reaction from Microsoft and Amazon today?
Yeah, so the calculus is, there's an expectation the quarter was really strong from Microsoft and Meta. But after Alphabet, you have to justify future Capex expansion. Microsoft's probably the most tangible case study of that, right? Azure, the cloud computing unit, will likely grow beyond 40% in the quarter gone. Microsoft will close the book on its fiscal year and give us a real guide on Capex for the next fiscal year. But if Capex jumps from $147 billion to $230 billion as the street thinks, that would represent pace of Capex growth far outpacing top-line growth on Azure. Azure growth 40% odd, Capex growth maybe 50 to 60%. And that's the worry, that they need to show much more ROI in the near term and a better guide long term.
Ed, just elsewhere in the tech world that I'm sure you're going to cover on Bloomberg Tech today is learning more details of the OpenAI hack on Hugging Face, that it first accessed a customer cloud account before it launched this attack. Just the skeptic in me is kind of like, is this just good marketing for OpenAI to be like, look how great our models are, that they're basically so advanced they can escape from the sandbox and wreak all this havoc?
So in the first instance, this is kind of a separate case study of the same models behaving that way. And again, in aggregate, the industry kind of cheered how OpenAI communicated on this. It's not a scandal. You want the frontier labs to be testing cyber capabilities, but see that there's a procedure in place to catch it. With the modal situation, think of it as modal. The OpenAI models are the attacker, and they found somebody's unlocked computer to use. So basically, this didn't compromise the modal platform itself. Within modal, a specific customer had a sandboxed environment that it made publicly accessible. So all the OpenAI models were able to do was get into that sandbox or closed testing environment, and then basically treat it as a staging point. They could work with code within the sandbox, but nothing outside of it. And again, like the companies now are communicating about it, it is the latest example that AI being an attacker in the cyber context is real. And that has been an endless conversation for 7 to 10 days.
Ed, again, really looking forward to Bloomberg Tech, 11 a.m. every weekday. Bloomberg Tech host Ed Ludlow. Elsewhere in earnings, Ford is raising its profit outlook for the second time this year. The automaker cashing in on resilient demand for SUVs and pickups. Joining us now is Bloomberg auto reporter Keith Naughton in Detroit. Keith, great to see you. So is this just the really expensive stuff from Ford is being bought? Is that what it is, the upper-end consumer?
Yeah, it really is, and it's the Bronco SUV had a record first half, and the Explorer SUV is doing really well. And it's not just the regular mainstream models. Customers are buying the fully tricked out models with the off-road performance packages, and those are very high margin.
Well, it's that, and then I also wonder how the rest of its business is doing, Keith. Besides the high margin, what about just the more everyday vehicles that they offer?
Yeah, well, the big one to watch is the F-Series pickup, their top-selling model, and you know that has been down because of the fires it had at the aluminum supplier Novelis last year. That's starting to come back, and momentum is beginning to shift on the stock. Mike Ward of Citi today raised the stock to a buy from neutral, and he sees 28% growth in F-Series sales in the second half of the year, which he says will be a profit tailwind.
We've also seen Ford rally in recent days sort of on the AI hype and some of what they're doing to provide some battery purposes, kind of like retooling EV battery plants for energy storage and helping sort of the AI ecosystem. How is that business going for Ford?
Yeah, it's really driven the stock way up this year. They had their best month in May in 17 years. It's a very promising business for them, high margin. They're building it out. They have one customer already. Jim Farley, the CEO, says there's a lot of interest from hyperscalers, from data centers. The energy storage is a growth business, and Ford is right in the middle of it.
Hey, Keith, thank you so much for joining on those Ford earnings. That's Bloomberg's Keith Naughton in Detroit. We also, in terms of events we need to get through today, before all of the big tech earnings, we're going to have the Fed. And rates are expected to stay on hold this afternoon. But there are some in this market bracing for the possibility of a surprise hike. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now. So, Mike, about just over 1 in 3 odds that we hike. Bank of America points out that should the Fed hike, it would be unprecedented since at least 1994 that you haven't had a Fed hike when the market is this uncertain about it.
Yeah, this is the most live, if you want to put it that way, meeting that I can remember in a very long time, because you can argue it either way. You can make a case for raising rates. You can make a case for holding. And if you divide up the members of the Open Market Committee who will vote today, you can come up with a pretty much a tie vote there, because among those who have said that they would raise rates now, or they would consider raising rates if inflation was still going up, if oil prices were still going up, you got 6 votes. On the other side, the people who have said they're not interested or who have not talked since then, there's 6 votes there, and the guy on the bottom right is the one that is most important, because he'll try to frame the decision and get people to do what he thinks is best, and we'll see how that all turns out. Of course, economists overwhelmingly see a hold today, and you do have that market probability of about a 35% chance of an increase. We haven't had any kind of surprise, really, since June of 2022, when they raised rates 75 basis points, and the surprise was in the amount of the increase, not the increase itself. But we also don't get any dot plot or new economic forecast today, so not much to build your case for what goes on next time. We'll be looking to see what Kevin Warsh says. We'll be looking to see if there are any dissents and if the statement recognizes those dissents. How's he going to explain any dissents? How's he going to explain the decision? And what are he and his colleagues watching going forward? Right now, we have a September meeting priced in for a rate increase. Will it still be the same at 3:30 this afternoon when Kevin Warsh is done speaking?
Given that this is a Fed chair who doesn't want to give any guidance going forward, as you pointed out, Michael McKee, it's a dynamic that Nick Timmeros over at the Journal has been writing about, this idea that usually you can reach compromise with other FOMC members by changing the statement, a dovish tweak or a hawkish tweak there, maybe kind of indicating what you might do at the next meeting to sate all of the different opinions. If Chair Warsh doesn't have that ability, because he doesn't want to do that, does it make it that much harder to corral opinion at the FOMC?
Well, it makes it a little bit harder. I don't think it's determinative in the sense that there are people who would like to raise rates now, but the 2 who vote, Hammack and Logan this time, who want to raise rates, that's only 2 of the 12. The others have said if the economy started to look like it was suffering from higher oil prices or the war effects, they would be interested in raising rates. So right now, he can make the case that, well, oil prices until today had been coming down again, and we have a lot more inflation data between now and September, so why don't we wait? I think that's probably going to carry the day today, but if Kevin Warsh wanted to signal anything, maybe he'd tell people to look at the color of what you're wearing, Dani?
I've already had one person message me saying, oh, no, not red. But, you know, maybe we can kind of adopt a more Chinese outlook today and say, hey, red's the color of luck, McKee. So that's what I'm sending out there to everybody today. Good luck on a very busy day. You too, Michael McKee. And don't miss Mike and the surveillance team's special Fed coverage of the Fed decision. That will kick off at 1:30 p.m. New York time. Let's get a check on your markets. I'm sorry I'm kind of matching markets and what they're doing this morning, but come on, barely. We're only down 0.1% for the S&P and for the NASDAQ. By the way, yesterday, the equal-weighted S&P reached another all-time high. It was spared from the stress of the rest of this market, and that was another sell-off in semiconductors that started in Asia. Again, not as bad today, but we are just waiting for earnings and a Fed decision. Ahead of that Fed decision, oil rises again with the president speaking on Fox about hitting Iran hard. Brent crude goes up nearly 7% to just under $90 a barrel, while 10-year yields up 2 basis points. Let's look at some of the individual movers this morning. With that is Nora Melinda. Hey, Nora.
3 stocks on my radar for you this morning, Dani. Let's start with Procter & Gamble. Shares down about 4.2% in the pre-market trade. We saw second quarter results that missed expectations. The company giving a conservative outlook for the year with consumers searching for value. We did see that P&G has been really struggling to win market share from its competitors as expenses climb and the company does its best to avoid some of those price hikes. From there, we're going to turn for a look at the commodity trading house Glencore. The company up about 3.6% before the opening bell and reporting $3 billion in profit for the first half of the year. The Iran war is sending energy prices soaring and the company on track for one of its best years ever as the war and AI infrastructure impact metal prices. Last up, we're looking at Next Era teaming up with Brookfield. The company up about 0.6% right now. The company teaming up with Brookfield to convert a Cold War uranium enrichment facility in Kentucky into an $100 billion data center campus. That's by 2031. The project will create about 8,000 construction jobs and 600 permanent positions. Shares of the company still higher before the opening bell. Those are your morning movers. Dani?
Nora, thank you so much. Coming up on the show, Brent crude moves higher as President Trump ramps up pressure on Iran again. That's after this break, right here on Open Interest. Let's get you some high-interest stories. A look at what's making headlines around the world. South Korean stocks plunged 16% in 2 days as retail investors dumped shares, sending the Kospi into a record monthly decline. AI worries deepened after weak SK Hynix results, triggering a second straight circuit breaker. By the way, the results themselves were really strong, but expectations were just that high. Officials are holding an emergency meeting to consider market support. Already, they've addressed limiting the ability of retail to buy leveraged ETFs. U.S. banks are pulling further ahead of their European rivals in trading. Goldman Sachs and JPMorgan posted record equities revenue as market volatility fueled client action. UBS, Barclays, and BNP also delivered strong gains, but investors are holding them to Wall Street's much higher standards. And President Trump says Iran will be, quote, hit hard after Iran launched missiles at a U.S. base in Jordan. The Pentagon says the missiles were intercepted while the U.S. and Saudi Arabia hit Iran-backed militias in Iraq. The renewed fighting is pushing oil prices higher and raising fears that the conflict could spread. Here joining us with the latest is Bloomberg Washington correspondent Tyler Kendall. Tyler?
Hey, Dani. Well, there's a lot of fast-moving updates this morning as President Trump is now renewing this threat to hit Iran hard after CENTCOM confirmed that the U.S. successfully intercepted that surprise attack on U.S. forces in the region, which was considered to be a pretty massive escalation since we had been amid what was this lull in the fighting in a bid to give diplomacy a better chance. But now instead we're seeing a renewed focus on Iraq. As you mentioned, the U.S. and Saudi Arabia forces had teamed up to hit some sites in the country there after Saudi Arabia claimed that Iranian-backed proxy militia groups in the country had taken aim at them with drones. We got a little bit more insight on this operation from President Trump in remarks earlier today from Fox News, saying that the attacks in Iraq were coordinated with the Iraqi government, but it appears officials there are now disputing that account. We got this new statement within the last hour or so from the Iraqi president, saying that these attacks were unacceptable and a violation of sovereignty. Dani, we know that this White House has been working to dilute the power and influence Iran has over its proxy groups. President Trump had just hosted the Iraqi prime minister here in Washington a few weeks ago. President Trump told me on Air Force One earlier this week that the U.S. is in constant contact with Saudi Arabia when it comes to the Houthis in Yemen, because we are still seeing those shipping disruptions there. And new this morning, a new report from Reuters is adding to the heightened tensions, saying that the Houthis are reportedly considering adding fees for any ships trying to transit through the Red Sea.
Tyler, this is a president who also, when asked about the possibility of continuing talks, said, we're going to let them keep talking. But these attacks, does it just underscore how far away we are from diplomacy? Is there any attempts at diplomacy still happening in the background that we know of?
I mean, Dani, last night, President Trump said that he really wanted to opt for that that renewed diplomatic effort. It had been our understanding that talks were happening, according to some senior U.S. officials, at both the technical level as well as the leadership level. As of now, we'll have to see how they develop from here, because we know, importantly, talks had to happen about reopening the Strait of Hormuz before we can even consider those negotiations turning towards what potential curbs on Iran's nuclear program would look like. And new overnight, we didn't really get encouraging information on that front. Iran's foreign ministry coming out with a statement saying that the country had rejected the latest proposal from Oman when it comes to reopening the Strait of Hormuz. Oman had proposed that they would utilize that so-called middle passage in the Strait, giving both countries equal and joint control. But Iran is saying that their country is vying for sole control of any ships that are transiting through, and that no doubt is going to add to the escalation and hinder those diplomatic efforts, because you need the Strait to be open in order for the talks to continue.
Hey, Tyler, thank you so much for that update. Bloomberg's Tyler Kendall in Washington, D.C. Coming up, Visa and SoFi beat Wall Street estimates, but both are falling in the pre-market. We're going to get more into corporate earnings coming up next. This is Bloomberg Open Interest. Visa beat earnings estimates, but shares are down 2%. The company disclosing a $563 million charge tied to job cuts, which we learned about yesterday. We learned that with our Bloomberg consumer finance reporter, Paige Smith, who joins us yet again. Paige, good to see you. A busy 2 days for you. Is this the reason why shares are selling off? Is it just that charge specifically tied to that 2,600 people's worth of layoffs they're doing?
Yeah, if you think of sort of the rest of the metrics that the firm reported, it really was a positive. It was a positive quarter for the payments firm. I mean, you think about consumers are still spending, businesses are still spending. There are still high growth opportunities for the company, but certainly there was that job cut news yesterday. And it was interesting. We got a little bit more, we got some more color on just exactly the kinds of jobs that were being targeted in that action on the call last night. Specifically, the product development teams are essentially going to be made more nimble. So they described teams of 10 or more that were maybe going to be pared back to around 2 to 4 people.
Okay, that's a sizable cut for some of
Certainly.
for some of these companies. I mean, some of these teams. What about the more sort of traditional consumer business? I mean, just on a more macro scale, there is this confusion about how the consumer is. How did things shape up for that part of Visa's business?
Well, if you think about how Visa functions as an entity, essentially any time a transaction is made, Visa gets a cut, or a sort of payment processor of some kind gets a cut. So as long as spending continues in some capacity, firms will profit off of that. But at the same time, there is this confusion about how the consumer is doing, and also a lot of confusion about there is a lot of geopolitical uncertainty underlying major corporate decisions that also contribute to Visa's success and other payment firm's success.
Just real quick, because we also had SoFi earnings. Same thing here, just like expenses being a problem for them?
Yes, we saw expenses were up a little bit. And just to sort of step back for payments and fintech generally, SoFi reported earnings today. We also have Robinhood aftermarket. Something to watch too, because similar areas, they all play in similar areas.
Does Robinhood do well for the same reason the banks did well, that there's a lot of volatility and a lot more trading, and that's good for them?
There's a lot of volatility, but one thing to actually watch on Robinhood is going to be the prediction markets revenue, which is people are watching closely to see if it will properly eclipse crypto revenue for the first time. So that's a metric to watch.
Feels like such a sign of the times. That prediction markets are more, that like it used to be crypto being the hot thing for them, and now it's that everything is a casino.
And it could come back. We'll see.
Yeah, true. It's a good point. It's not dead. Paige, thank you so much for joining. Great to see you again. Bloomberg's Paige Smith. And catch the SoFi CEO Anthony Nato on Bloomberg Tech. That will be at 11:30 a.m. New York time today. Let's get a check on markets. Less than 5 minutes to go until your opening bell. And we're going a whole lot of nowhere after a sell-off in tech yesterday. But the equal-weighted S&P reaching a new record. Yields move higher alongside the price of oil. So just 4 minutes until your opening bell. We begin your trading day with JPMorgan Sitara Sundar. That's coming up next. This is Bloomberg Open Interest. Moments away from the start of trading, you're watching Bloomberg Open Interest. I'm Dani Burger. Matt Miller still on paternity leave, and we're gearing up for a really busy day. Most of it will happen closer to the close. So we have a Fed decision at 2, followed by a presser at 2:30. Then we have earnings from Microsoft and Amazon, followed by more hyperscalers tomorrow. And ahead of that, going a whole lot of nowhere. It was tech that underperformed yesterday. Most equities did well yesterday, despite semiconductors, but that did drag us down a little bit. Opening the bell at the NASDAQ. It's a New York Stock Exchange, rather. It's a nonprofit called Accor. I think it's around clean energy. Gosh, the New York Stock Exchange have had so many nonprofits and various charities ringing the opening bell. Interesting, because we're in the midst of a lot of IPOs. Maybe more of them are happening at the NASDAQ. We have I believe this is a cloud computing company, Cumulus AI, like a cloud. If only I could read properly. Ringing the opening bell down at the NASDAQ with some adorable children up at the front. You gotta bring your kids to ring the opening bell, a once-in-a-lifetime experience. Here's how the big tech players are shaping up in this morning's trade. So you have Microsoft and Meta, both of them are slightly down about 0.5% in the case of Meta. They're going to have a high bar when they report earnings after the bell, with higher AI spending met with disappointment on Wall Street. So that's actually a good correction. I think I said Amazon is reporting. It is Meta after the bell today. SK Hynix, though, the perhaps perfect example of what we might see. Shares are down, even though they reported a 6-fold jump in profit and a 50% rise in planned capital investments. Let's bring in JPMorgan Private Bank Head of Alternative Investment Strategy, Sitara Sundar. Sitara, great to see you. And I wonder if that just is what we need to expect from this earnings season. The bar is so high that even if you meet it or slightly exceed it, it's not good enough, that shares will sell off.
Yeah, look, the hurdle rate is higher, and part of that reason is we need to take into account where we've been. We're 3 years plus into the cycle. During that period of time, S&P has annualized 20%, semiconductors have annualized 50% plus, NASDAQ is up 30% plus annualized during that period of time. It's a meaningful amount of price appreciation to the extent that we haven't seen in multiple decades. So what I think, there are two questions that I think the market is trying to answer at this point in time right now. Is the investment that we're making within the build out of artificial intelligence infrastructure, whether that's the power side, whether that's the semiconductor side, whether that's the memory side, are we finally going to see the payoff of that? Is it finally going to come to a point in time where we're in the year of ROI? Show me the productivity benefits, show me what the long-term potential of it is so I can justify the spending. And then two, who the ultimate winners of this cycle are going to be. We're in a meaningful digestion period within artificial intelligence where some of the biggest infrastructure winners are taking a bit of a breather. And the ultimate question is what is going to increase adoption? And even within the frontier models in the LLM landscape, who is going to be the winner there? Is it going to be closed models? Is it going to be open source? Like, how are we thinking about that? And that is, I think, the two questions that the market is trying to digest, which means that everyone is very attuned to the folks who have won so far, and the hyperscalers are one of those players.
And then I guess the chip makers are too, because if you can report an 86% rise in revenue, that seems to be a good place to be. But has something changed for this market, given that, I guess, digestion period that you explained that we're in? Is that no longer kind of like a safe, cushy place to hide out just because of the remarkable volatility, even though there's been really robust year-to-date gains?
Yeah, there's this near-term, long-term tension. For the longest time, the right place to be has been investing in the folks who are trying to relieve the bottlenecks in the AI ecosystem right now. Power, compute, semiconductor players are a big part of that, memory too, and we've seen some kind of cyclical technical rotation within that. But the second part of it too is, I think, a refocus on what the long-term potential of this is. What does the integration of artificial intelligence into the real economy look like? So I think what you're likely going to see, not just in this week, but even longer term, is both of those trades playing out at the same time. Some people taking some chips off the table on the winners of the past 3 years and thinking through what the future winners could look like, whether that's the services business, whether it's like financials, whether it's industrials, whether it's healthcare-oriented businesses. You're even seeing that in what you mentioned earlier on the S&P equal weight actually starting to rally, trying to think through investing in the opportunities of not the businesses and the companies that have built and invested in the AI infrastructure, but those that will benefit from integrating that technology into their day-to-day businesses without having to front the Capex.
This is something that Mike Wilson has talked about, that you will start to see the companies who've been integrating AI start to pay off. I wonder how you're looking at this on the private market side of things, because every day you hear of a multiple billion-dollar data center project. Today, it's NextEra in Brookfield in Kentucky, $100 billion, which is quite a chunky chunk of change, if that makes any sense at all. Again, a lot of this is happening on the private capital side of things. Yes. How are you directing your clients when you don't have a mark-to-market sort of environment to take bets on what makes sense and what might look like an overspend? Yeah, so I think the number one thing to think about, especially if you're going to lock up your money for at least 5, 7, 10-year type of time horizon is what is a durable trend that I can get behind. Point number one is that despite all of the build that we're seeing within data centers, despite all the build that we're seeing on the power side, we are still in a meaningful supply-demand imbalance in terms of the demand that is needed for power and energy, not just within artificial intelligence, but general electrification of the economy. We're still in a massive supply-demand imbalance within the U.S., but definitely globally. The U.S. actually might end up in a situation where the amount of demand is going to far outreach the supply even by the end of this decade. So we're still compute constrained. We're still in a supply-demand imbalance, which means infrastructure and private infrastructure and these like public-private partnerships that you're starting to see play out is a durable trend, in our opinion, moving forward. So infrastructure and private infrastructure has given our client portfolios and client conversations two benefits. One, you have access to this secular theme, but in a more durable way, because at the end of the day, these returns are based on multi-year contractual cash flow, so you have visibility into the cash flow profile. But then two, the other thing that we haven't talked about yet is inflation volatility and what's going on in terms of either the geopolitical tensions that we're seeing so far this year, but what has really been persistent inflation volatility over the past 5 years, given the amount of supply side related shocks that we've seen on a rolling basis. And whether it's infrastructure or whether it's real assets or in real estate, you're starting to see this pickup in client demand, and even for us from a long-term investment perspective, because you get to a certain extent inflation resilient income. And that's a necessary complement because core fixed income always has a role to play in terms of a defensive ballast within a larger portfolio. But it tends to have a more difficult time in protecting an inflation-oriented environment. Okay, this is really interesting because this is an argument that Akhil Bansal of Carlyle, who heads up infrastructure there, came on to make in a new paper. He heads up ABF, to be more specific, but obviously a lot of infrastructure, saying, I mean, it benefited him, this argument, and he said as much. I know I'm talking my book, but it's true. This idea that traditional fixed income is less appealing because of inflation volatility. And then on the other side of things, corporate credit Just so many tech players have been issuing new debt that it actually looks a lot like equity. So for portfolios, is traditional fixed income just less attractive, or its use has just changed in terms of a diversifier to equities, let's say?
Yeah, I think for the longest time, post-global financial crisis to pre-2022, the entire conversation was around where can I get carry? Because fixed income wasn't giving me the same amount because we were in a near zero rate environment. We're in a different environment right now, regardless of what the Fed may or may not do later today. We're in an environment right now where rates are higher. So therefore, there are actually pockets of public fixed income that are starting to look a little bit more competitive, primarily because your carry is higher than it has been in the past. But on the flip side of it, the conversation around what that 40 part of your portfolio and what those diversifiers mean has just fundamentally shifted from where can I get the best yield to where can I get the best yield that will either defend me in a higher inflation volatility environment, which is where not just the real assets, but we're constructive on asset-backed finance as well. But then two, even thinking about ways to lean into less correlated return streams. And that, despite the volatility that we've seen so far this year within the hedge fund landscape, hedge funds are starting to get brought up in conversations, and we're more constructive on that too.
But aren't they really concentrated too? And I think about that, Sitara, just quickly, because we're almost out of time. There was a story that Wall Street banks have been pushing hedge funds, kind of being like, you need to start putting up more collateral just because we're worried about the concentration risk you have in AI.
Yeah, I think it depends on which hedge fund you're invested in. There's like some areas within long short that have been very levered to the AI trading that are feeling some of the heat from the momentum unwind that we've seen so far this month. But there are other areas that lean into less correlated return streams, whether that's macro, whether that's relative value on a longer term basis, where you can better capitalize on these intra-asset classes and intra-geographies, market mispricings that you're able to generate not just less correlated return streams, but higher alpha generation at the end of the day too. But the biggest thing that we talk about is hedge funds are an industry, not an asset class, and who you pick matters.
Very well said. Sitara, thank you so much for joining. Such a pleasure to have you on JPMorgan's Sitara Sundar. Let's get a check on your equity market over 10 minutes into your trading day. And we are hanging tight, down about 0.1%. Pretty even split between winners and losers. A lot of winners yesterday, despite an S&P that finished more or less flat, not too much of a gain. In the gainer side, we have a lot of the energy players, given the price of oil is higher today with President Trump threatening to hit Iran hard. Exxon is up there. Apple, just in terms of points, is one of the top gainers. Yesterday, it closed just below $5 trillion, so we'll see if we can get through that level today. Coca-Cola is up after reporting earnings yesterday. Seagate reported earnings today, and that was a beat for the hardware company. On the downside, you have a lot of the big cap tech. NVIDIA, Microsoft, Amazon are down. SK Hynix reported earnings, and those shares are falling. P&G also reporting earnings that missed expectations. So again, the consumer clearly is uneven, from Ford doing well to P&G not doing well. In terms of your sectors, energy is the standout just because the price of oil is moving higher today. So energy up 2.5%. Industrials, materials, infotech, those round out your bottom sectors. Coming up, semiconductor stocks under pressure as investors take a harder look at the AI trade. We're going to have more with Mandeep Singh. That's coming up next. Time now for your top calls. Here is Nora with some of the analyst action this morning. Nora.
Well, let's dive right in. First up, I'm looking at Caterpillar, shares dropping to April lows. The company getting a downgrade at Baird. Analysts over there saying that growing restrictions on data centers can not only slow down AI spending, but also hurt future equipment demand. That's not going to be good for Caterpillar if it plays out that way. Next up, Dani, I hope you're hungry because I am. Morgan Stanley upgrading the Cheesecake Factory to equal weight from underweight. Analysts say that sales can pick up in the second half. New menu items, stronger marketing, and its loyalty program expected to send more foot traffic through those restaurant doors. I need a slice of cheesecake. Last up, Texas Instruments getting an upgrade at Arete. Arete saying the AI boom could keep the analog chip market tight for the next 2 to 3 years. That's certainly a perk for Texas Instruments. Shares up about 0.6% right now. Seems like that AI demand just isn't slowing down, Dani.
Girl, can I just say, it is 9:40 a.m. and you want a slice of cheesecake?
Why not? We can always have a slice of cheesecake.
Live your life. I love it. Nora, thank you so much. We'll catch up with you later in the next hour. SK Hynix elsewhere reporting a surge in quarterly profit as demand soars, but that wasn't enough to impress Wall Street. It raised its spending plans by 50% to $31 billion. It originally sent shares lower. Now we're up by 1.1%. Let's discuss with Bloomberg Intelligence head of global tech coverage, Mandeep Singh. Mandeep, I was so ready to be like, oh, it doesn't matter if you have like a 500% increase in profits. The market wants more, and we're kind of up today. So, okay, let's scrap that narrative. What was your overall takeaway of SK Hynix?
That right now these memory companies are showing, 40, 50% quarter-over-quarter growth because pricing has been so strong. I think what they referred to in the earnings call is, look, we are looking to sign more long-term agreements. That's what Micron said, and that's what these guys are doing. They want to enter into 4 or 5 year agreements with all their big customers where they cap the pricing, but they also have the visibility that, customers are going to buy from them, and it's not going to be spot pricing driven, which is how the memory market
Does that mean that we need to get away from the world where we are trading at 8-9 times multiples, that it should be higher because they're not cyclical anymore if they have these longer term contracts?
I think that's harder to change given the nature of the memory market, and a lot of it is driven by the fact that demand is really strong on the HBM side, but all the pricing growth is coming from the conventional DRAM side. And that's where companies like Apple have complained. They want to qualify, Chinese CXMT for use in their devices because they don't need HBM. They just need the conventional DRAM where they have to pay, 30, 40% higher memory prices. And that's where these companies are walking a kind of a tough line in terms of making sure they don't really, have a rough time with one of their main customers, which is Apple in this case.
Right. Well, I believe it was Micron that came out in their earnings and essentially said when prices were at rock bottom, we tried to negotiate with the company. I think it was implicit that it was Apple saying, no, we need to charge you a higher price in order to keep investing. And they weren't able to do that. I wonder if that argument now is compelling to an Apple, or should prices start to fall, they're just going to be like, hey, that's the nature of the business. We're not paying you as much.
Yeah, I mean, look, SK Hynix said they have LTAs with 10 of their customers. I'm guessing 10 could possibly include someone like Apple, but again, they want to make sure they have like a broad suite of products that includes DRAM, HBM, and other things, NAND. And so from that perspective, if there is an agreement that encapsulates everything, that will be a lot more palatable to a potential customer.
So does all this mean that we've basically reached the peak of pricing power? And if we have, is that not good news for the hyperscalers that we're freaking out about how much they're spending on Capex? Doesn't that start to come in if they don't need to spend as much on things like DRAM?
I think so. You bring up a good point that a lot of the Capex increases that we saw from Google last week was likely because of memory price increases, and I expect the same for Microsoft and Meta. When they report, they have to pay up at least for this year. And then going forward, if they're in an LTA, then actually it's good news from that perspective. At least you're not paying for component memory pricing. And yes, you still want to expand your capacity, but you don't have to pay up for, the components.
All right, Mandeep, thank you so much for joining. Appreciate your time. That is Mandeep Singh gearing up for a busy day of earnings both today and tomorrow. Elsewhere in earnings, P&G results falling short as consumers pull back on spending. We'll break down those results with Red Brown coming up next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. Let's get a check on your equity market 20 minutes into your trading day as we await both a Fed decision and earnings from big tech. NASDAQ falls 0.5%. The S&P down 1/3, following on from yet another day of selling and circuit breakers in South Korea after SK Hynix reporting earnings. Dow is also down by 1%. 10-year yields, though, are moving higher by 1 basis point. We're at 462 as the price of Brent crude moves higher alongside it, given the president's threat threats to Iran on, hitting them back even harder. In terms of individual stocks, Micron, you can see they're down 2%, Nvidia down, Humana also lower. Visa is higher after they reported earnings. They did have higher expenses after letting about 2,600 employees go, or at least announcing plans to do so. Even so, the rest of the results looking pretty strong, so shares are moving higher. Ford, another read on the consumer, up 7.5%. Strong sales for their most expensive cars, for SUVs, for trucks, so shares going up 7.25%. Also, their energy battery business doing well too, which has started to apply to AI. And then P&G, Procter & Gamble, down nearly 7%. A tepid outlook. Quarterly results miss estimates. Let's dig into the details. Joining us now is Bloomberg consumer reporter Red Brown. Red, what were those details?
Yeah, I think the details that kind of emerge from this call is that P&G and other consumer companies are in a really kind of complicated position, right? They have the cost inflations that we're seeing kind of across the supply chain resulting from obviously the Middle East conflict, but at the same time, they're not able to kind of offset those costs in their business because consumers just have no capacity for this after so many years of inflation. So they're in this really sort of delicate balance on like how do you get yourself out of this sort of narrow market they're in.
But by the way, so the increased costs, is it about shipping? Is it the price of plastics going higher because of what's happening in the Strait of Hormuz? Is it all of the above?
It's all the above. So the company reiterated its outlook for cost inflation to be $1 billion in the coming year, but they really emphasized the fact that a lot of it's coming from these non-commodity inputs as well. So it's things like cost of shipping. They've had to change their suppliers as well, as some of them are in areas where they can, maybe not operate at the capacity that the company needs. So it's all of these things sort of filtering in. And right now the company is expecting that to hit earlier in the fiscal year for them and resulting in a 5% drop in their earnings. So we kind of see how this is really hitting in the near term with hopefully plans that P&G is purporting to put in place will hopefully get them back into the growth towards the end of the fiscal year.
Just with all of this and the state of the consumer, because we have seen data that suggests the consumer is still spending. Visa, for example, posts earnings today and it shows that the consumer is resilient. People are buying expensive Ford trucks. Is the difference with P&G just that sure the consumer is spending, but they're not willing to accept higher prices, and that's where it becomes an issue for them?
Yeah, exactly. Because people it becomes difficult for the company to grow its sales when they're not able to kind of push the prices through that they were able to when volumes are so kind of flat, right? So people aren't overspending. They're not buying more than what they need. They're buying exactly what they need, making what they have stretch. Squeezing every less bit of toothpaste out of the tube, things like that. So it does make it a little bit more difficult for them to, find that growth when the consumer is, resilient. We've heard terms of, kind of stable or muted. So the sort of language around how the consumer is doing is sort of shifting a little bit. But yeah, that does make it kind of complicated for a company like P&G.
P&G obviously has a lot of different types of consumer products. Well, what about the breakdown of different segments within it? Like, are things like beauty still robust, or is this kind of an across-the-board problem they're having?
I think it's a bit of an across-the-board problem. If you look across their 5 main markets, all of them disappointed this quarter. So they all came in under expectations. So it's also a regional thing. It seems like the U.S. and European markets are where some of these problems are showing up a little more. The company was kind of touting the progress they're making in China, but a lot of this is innovation driven. So this will be the way that the company gets out. They're gonna have to kind of spend their way through this. Again, deal with a little bit of this kind of short-term pain for hopefully long-term gain.
Right.
But obviously that remains to be seen.
All right, Red, thank you once again for joining us. Loved having you on every day this week. This is so great. Red Brown from our Bloomberg consumer team. Coming up in the next hour, we're going to speak with Goldman's chief U.S. economist David Mericle about the Fed and data to come. We also talk AI investing with battery Ventures general partner Dharmesh Thakker, and Logitech CEO discusses gaming hardware and more. This is Bloomberg Open Interest, your hour 2, right after this break. "30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Burger. Matt Miller still off as we cope with declines heading into a big day of Fed decisions and earnings. Coming up on the show, SK Hynix set the stage for a big day for tech earnings. Microsoft and Meta, they take the spotlight next. To hike or to hold, markets see a growing chance of a surprise from the Federal Reserve today. And Middle East tensions flare up yet again. Oil jumps as the president threatens Iran with new strikes. We begin with a Fed rate decision less than 4 hours away. Former Kansas City Fed President Esther George weighing in on market uncertainty heading into the FOMC meeting.
It's a good move in the sense of not trying to forecast and lay the groundwork for upcoming moves. I think the market doing this work is probably an important development here. And at the same time, while you're going to stop short of giving forward guidance, I think it's always helpful to be clear about what you are looking for. So today, I think will be important to listen to what is the rationale, how is the committee thinking about the current state of the economy.
Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent in Washington, D.C. Mike, just break down what we might get from the Fed today.
Well, everybody's going to be looking for that explanation Esther George was talking about, even if they aren't necessarily looking for a rate increase, at least not yet. Right now, economists overwhelmingly opposed to that. According to the Bloomberg survey, 87 of 88 say the Fed will remain on hold. Wall Street odds still a 35% chance of an increase. Oil prices are up today, but it hasn't moved odds on the Fed decision. The last time we had a surprise where they did something unexpected was June of 2022, a 75 basis point hike, but that was a matter of the amount of the hike rather than the fact that they did move. There are no economic forecasts or dot plot this meeting, so there isn't going to be a whole lot for investors to chew upon, except for Kevin Warsh and except for the idea of where does inflation go from here. As you've been talking about, we have seen crude oil prices go up and down, up and down. They went down in late May, early June, and then went back up again in recent weeks over the president's renewed warfare. And then today, they're back up again after starting to slide down. So how does the Fed figure this out and figure out what it's going to mean for the overall economy? That's a question for Kevin Warsh. So his news conference does become very important. One of the key questions is, will there be any dissents? Will the statement mention the dissents? Will Kevin Warsh explain what the dissenters meant if there are dissents? How does he explain the decision itself? How does he make the trade-off between the inflation outlook, that inflation won't get back to 2% anytime soon, and the idea that maybe they need more data and more time to wait to see where inflation's going? What are Walsh and his his colleagues watching as we go forward? 2 more CPI, 2 more PPI, 2 more PCE inflation reports. Are those going to be dispositive? Is there something else they want to see before they make a decision in September? Which leaves us with the question of, what do the markets think when this is all over? Will a September move be priced in? It already is. Does that go away because of something Kevin Warsh says? Or does it get even stronger, Dani?
Mike, thank you very much, and looking forward to your coverage of this Fed decision. Bloomberg's Michael McKee in Washington. Joining us now is Goldman's chief U.S. economist, David Mericle, who expects the Fed to leave rates unchanged, writing, quote, "The Fed has historically avoided delivering surprise rate hikes, and we suspect that voters might be especially reluctant to do so at a meeting without a summary of economic projections." David, really wonderful to have you here today. And that's what the Fed has historically done. Why do you think they'll stick with that, especially given that this is a Fed Chair Warsh who is trying to veer away from recent history?
Yeah, well, thanks for having me here today. I think it's a fair question, and part of what you see in market pricing, with people taking this as much more uncertain than these meetings usually have been over the last few decades, is exactly that question of whether or not the new chairman and his new approach make that historical pattern maybe less applicable today. My guess is that it will really come down to the fact that we've had one round of inflation data. We saw not just the improvement that the voters wanted to see, but I think we saw, if anything, an even better outcome than anyone anticipated. And on the back of that, I would think most of those with a vote at least, are still comfortable holding today. But I do think that avoiding a hawkish surprise of a magnitude we haven't seen in really 3 decades is also a consideration for them.
It would be quite huge. I believe it's something like since 1994, we haven't had a hike with this lowest probability of odds that we've seen, under 60%. It's about 36% or so priced into this market. The argument, though, for Warsh hiking has been that he wants to take control from the markets and show that he is independent, show the White House that he can make a decision But I guess he still has a task force to hear from as well. So I wonder what that balance would be, if there is any credence to that argument of a Kevin Warsh who wants to take control.
I think about it a little bit differently. It is, of course, a committee decision, not just the chairman's decision. For me, the key issue is during the intermeeting period, and in particular, some of this happened during the blackout period when they haven't been able to communicate with us, we did see a renewal of geopolitical tension, and we did see upward pressure on oil prices. And I think you do hear from Fed officials that there is a frustration with this increasingly lengthy series of supply shocks, frustrating their efforts to get inflation back down to 2%. And with the reality that for them, like for all of us, it's just very hard to know when that will come to an end. If it had just been for the June CPI report, if that were the last piece of information, then I don't think there would be really that much debate about what they're going to do today. So I think it's more a question of, for the voters as a group, how big of an issue is this renewal of the war with Iran?
Nick Timiraos of the Wall Street Journal has been writing about this idea that usually a way that you can reach consensus is you give something to the doves or the hawks, depending on which way it goes, that you put something in your forward guidance, maybe indicating something a little bit more than one direction, maybe saying what you're going to do next meeting, or again, strongly suggesting it. If you don't have forward guidance from a Chair Warsh, does it make it harder to reach consensus because you don't have those tools at your disposal?
I think that's right. I think they could put into the FOMC statement just an acknowledgement that renewed geopolitical conflict poses upside risk to inflation. And I wouldn't think of that as forward guidance, but I would think of it as a nod in a hawkish direction. Now, the stronger version of that would, of course, be exactly as you're suggesting, to say, if we don't see a sustained improvement in inflation, then it's possible that we would have to raise rates later. A lot of them have said that individually, but I would also assume that there would be a reluctance on the new chairman's part to put that into the FOMC statement, because that does sound more like forward guidance.
By the way, so at the moment you're seeing re-escalation in the Middle East, and for now the price of oil still hovering below $90 a barrel. What are the knock-on effects? Because at the moment it's not a market that is really reacting forcefully to the developments. It's not the price of oil that's going up too much. So there we are at 89.69 on Brent crude this morning. What is the risk of further developments in the Middle East to inflation at this moment?
Yeah, for the U.S., this is mostly, although I would say not exclusively, an oil story, to the extent that we import goods from countries that also consume Middle Eastern natural gas. That spills over to us. To the extent that there are other more minor commodity exports that come out of the Strait, that can also have an impact. But it's mostly an oil story. And if oil prices stay where they are, then I think it's probably right to think that Q2 saw the largest effects on month-to-month inflation. It's not going to be zero in Q3 and Q4, but our models suggest that the effects should be shrinking. And I think that's true broadly of tariffs, of the effects of the war, of the effects of AI demand, should be diminishing going forward.
Is that something, again, the price of oil going higher, something that would even cause the Fed to hike, given you're addressing a supply issue, which hikes are not very good at addressing?
I agree with that. I think it's a point that's underappreciated, but you just get a lot of inflation out of supply shocks relative to the disinflation that you get out of, say, raising interest rates and pushing up the unemployment rate. And that's what lies behind the conventional central banker wisdom, that it's just not worth it to push unemployment up that much.
Even so, it's a consumer that does continue to spend as the price of gas creeps back up above $4 a barrel. It depends on what you're looking at. P&G may be a little bit weaker with their earnings, but people are still buying Ford vehicles. Visa earnings really good with credit card spending. And I just wonder where you see as the resilience of the consumer at this state. If there is finally price fatigue setting in and maybe the consumer is starting to look a little weaker, or if we really just are hanging in there.
Yeah, you're absolutely right that over the last few months, the consumption data have looked quite strong, given the increase in oil prices and the impact on gasoline prices and the hit to consumer income from that. I think the key to this puzzle is that the increase in gasoline prices just happened to overlap with the peak tax refunds that we've seen. Now, it looks to us like the impact of that on monthly cash flow is now basically over. So if oil prices, gasoline prices stay higher, that should deliver more of a blow to real income growth. And for exactly that reason, we are expecting in the back half of the year to see weaker consumption growth than we've seen over the last few months.
Wait, so ironically, I feel like what I'm hearing from you is that higher oil prices, if anything, it's a reason to stay on hold because it weakens the consumer at this point.
Well, I think there are considerations in both directions. I don't think that's how the Fed will see it on net. I think they'll be very nervous that, as many of them have said, inflation's been high for a long time. And what they're worried about is even if this is not our fault, even if this is not a reflection of excess aggregate demand, even if rate hikes are not going to be a hugely effective tool in managing this, you worry that if people experience high inflation for long enough, they'll get accustomed to it. And the price of oil affects the price of many other things. And it's also a price that people pay a lot of attention to when they fill up their tank of gasoline.
It is very true. David, thank you so much for joining us ahead of that Fed decision. David Mericle of Goldman Sachs. And don't miss our special coverage of that decision. The surveillance team will be kicking things off at 1:30 p.m. New York time. Let's get a check on markets ahead of that all-important meeting and tech earnings. We continue to fall, following on from volatility in the South Korean session. Another day of circuit breakers over there. The Nasdaq falling about 0.7%. The S&P down about 37 points. The 10-year yield moves higher by 2 basis points following the price of oil as the president threatens more tough action on Iran. That's up by 6.6%, just under $90 a barrel. Let's look at some of your single name movers. With that is Nora Melinda. Hey, Nora.
Hey, a few stocks on my mind this morning. Let's start to the upside. SK Hynix rising about 2.2%. The company is saying it expects capital investments to rise around 50% this year to at least $31 billion. Now, this is driving some concerns about overinvestment in AI capacity, but shares still pointing higher right now this morning. The company reporting a 6-fold profit surge, and that's clearly pushing the stock higher. Sticking with tech, we've got two of the world's biggest AI spenders reporting after the closing bell today. Microsoft, Meta face a high bar, with investors ready to punish or reward the companies depending on where they say they're stashing their cash. Both stocks down double digits, though, so far this year. And lastly, over to Ford, we got to look at the automaker raising its profit guide for the second time this year. Shares of the company up about 8% this morning. Demand for EVs has been soft, but clearly its SUVs are helping drive company results. Those are your morning movers. Dani?
Nora, thank you very much. Coming up on the show, we're going to be speaking to Battery Ventures general partner Dharmesh Thakker about the next wave of enterprise AI. That's coming up next. This is Open Interest. Get you some high interest stories, a look at what's making headlines around the world. Anthony Fauci invoking his Fifth Amendment rights and declining to testify at a Senate hearing on the U.S. response to COVID-19. Fauci said the hearing was designed to pressure him into making incriminating statements.
The only conclusion I can reach is that the sole reason he is calling me before this committee is to get me to say something, anything, that could vindicate his repeated public pledges that I end up, in his words, quote, behind bars, unquote.
Committee Chair Rand Paul repeated allegations that Fauci obscured evidence pointing to a lab in Wuhan, China, as the pandemic's origin. Elsewhere, Wall Street is cashing in on SpaceX's volatile debut, rolling out structured notes designed to cushion losses after the stock's steep sell-off. The products offer downside protection, some covering losses up to 50%, but they also cap potential gains, leaving investors exposed if shares fall beyond the safety net. And Liverpool FC could eventually get new majority owners. Bloomberg has learned that Amit Bhatia's consortium is negotiating to buy up to a 30% stake from Fenway Sports Group, with plans to increase ownership over time. I spoke with Liverpool FC CEO Billy Hogan yesterday, and I asked him about the investment.
We have been approached by a consortium that's led, managed, and represented by Amit Bhatia for a strategic minority investment in the club, and I wouldn't say anything other than that at this point.
Elsewhere in the world of investing, global investment firm Battery Ventures is co-leading a $75 million fundraising round for Freehand, whose AI agents manage supply chain spend for Fortune 500 companies. Freehand's customers include Meta, J&J, Dunkin', Pfizer, and Cardinal Health. Let's get more on the investment and other AI investments. Battery Ventures general partner Dharmesh Thakker joins us now. Dharmesh, so great to see you this morning. Look, this seems interesting. So what exactly is Freehand, and why invest in it?
Thank you for having me here, Dan. It's great to be here. Freehand automates the accounts payable workflow as well as many other strategic functions within the $2 trillion supply chain industry. It's fascinating. Supply chain is so important to the U.S. economy, and it's all the more disrupted with all the Middle East disruptions, tariffs, and the like. And yet, despite $2 trillion in contribution, barely $20 billion is spent in software in the supply chain industry. At Battery Ventures, we look for opportunities in large vertical markets like supply chain, where mission-critical workflows are not supported by the proportional software spend. And in doing all our work through our global offices, we identified Freehand as the market-leading product that starts with automating accounts payable, but in doing so builds the AI harness that lets you do many other functions, such as procurement planning, across some of the most exacting customers in the world, like Meta, Johnson & Johnson, and others. And behind this is a team that has strong domain expertise, as well as a deep AI workbench that has the right foundation to build this company.
Well, I know back in February, Battery closed a $3.25 billion funding round. The idea, part of it, your colleague spoke about this idea. Yes, we are going to be investing in software, maybe with an agentic bend, despite market panic over AI eating traditional software. How has that gone? How fast have you been able to deploy some of that fundraise?
There's no shortage of opportunities, as you know, Dani, these days. We're in this unusual venture cycle where the number of companies that are venture funding have gone up from almost 20,000 to over 50,000 as the cost of building products has gone down thanks to AI. On the other hand, the number of winners has really compressed from 200-300 public software companies to 30 to 50 companies that really matter and are now at unprecedented values of 100 billion and above. And so our jobs have gotten much harder, where we're looking at a much broader swath of companies, call it 8 to 10,000 a year, and trying to pick the best 8 to 10 companies that have the potential to be these market-leading franchises, hopefully like the Databrickses, the Gongs, the ClickHouses of the world, where we've been fortunate to participate and see the revenues grow almost 1,000x from single-digit millions to single-digit billions. We're looking
for this, when you're looking around at these opportunities, is the idea that some of the software stuff you can now get at bargain basement prices, or are you fully looking for AI-native tools?
I don't think there's such a clean separation of like AI versus SaaS. In many cases, public SaaS companies that seem to be beaten down in the SaaS apocalypse, many of them still have a chance to be AI native and embed AI workflows. And then there's new AI native companies that have a chance to disrupt the traditional software companies. So we don't look for AI native companies or SaaS. We look for software companies that have clear business value and are leveraging AI to drive clear business outcomes. Case in point, we have a company called Gong that automates a lot of sales automation, while Salesforce exists in many of those names. And so that's kind of how we look at the world.
And you're investing not in LLMs. And again, I know this is something that your colleagues talked about, this idea that you don't want to go and directly compete with an OpenAI or an Anthropic. But the development over the past month and even further than that is perhaps this won't be an oligopoly. You especially see Chinese open source models come in and look really attractive, look cheaper, look faster. And I just wonder, is the threat of a world where it's just Anthropic and OpenAI, maybe Gemini, is that fading, Dharmesh?
Yeah, look, first, we are not afraid to invest in foundation models. We have invested in one of the earliest US open source models called Reflection AI. We did look at OpenAI, Anthropic, and many others. But at the end, we think there's value in the enterprise, in data and the harness, which is kind of why we invested in Databricks and ClickHouse. And they work with OpenAI and Anthropic on one hand, and Reflection, as well as DeepSeek and Kimi on the other hand. And to your other question, Dani, is open source good for the world or not? I'm a big advocate of open source. It wasn't until Linux came to the forefront that server computing went mainstream. Open source foundation companies like Spark and MongoDB are behind many of the software companies in the world right now. So I think open source foundation models are good for the economy. They give you choice, and there's no reason why a basic task should pay 5 to 10x to an OpenAI and Anthropic, while you can do that same job with Nemotron or Llama or perhaps DeepSeek or Kimi. That's just the law of economics, and that makes sense. Having said that, Anthropic and OpenAI are driving value to some of the most exacting workloads, be it coding, drug discovery. And so I feel like there's plenty of opportunity for those frontier models to survive. But for the 80% of enterprise workflows that are relatively mundane, you can use open source in a way that makes economic sense to the end customer. And that in turn should help the AI wave grow even further. At Freehand, for example, we have Fortune 500 companies using Freehand software for accounts payable automation. And we use a combination of frontier and open source models in a way that drives the best economic value to a Meta.
I hate to rush you, but I got less than a minute here. And I'm just wondering, for these open source models, considering there are all these letters circulating around, is there any risk of actually using them, considering it might be an administration that turns a switch off and starts to bar their use, especially the Chinese ones?
I think that would be devastating for the US economy, where enterprise customers would have to pay much more than they really should. At the same time, there's many US open source alternatives that are coming up, so hopefully we can continue to leverage them without necessarily having the administration intervene.
Dharmesh, we're going to have to leave it there. Thank you so much for joining us. That's Dharmesh Thakker of Better Battery Ventures. Still ahead, Logitech warns of a supplier disruption that could weigh on holiday quarter sales. We're going to be speaking to the CEO. This is Bloomberg Open Interest. We are at the lows of the morning, with the Nasdaq now falling more than 1%. The S&P also falling 0.7%. We'll get a chance for maybe things to turn around or get worse, depending on what we hear from the Fed and from Meta and Microsoft when they report earnings today. 10-year yields, those jump by 2 basis points at 4.62 as the price of Brent crude rises by 7% as concerns of escalation in the Middle East continue. Coming up, more earnings on deck. The CEO of Logitech will join us on a supplier disruption clouding their outlook on an otherwise strong quarter. That's next. Okay. Logitech reporting earnings. Shares are trading lower this morning. Let's just get a check on those. Despite a strong quarter that topped expectations on sales, shares down 2.2%. Investors, though, are looking past an earnings beat after the company warned of a supplier disruption that could weigh on holiday quarter sales. Joining us now is the Logitech CEO, Hanneke Faber. Hanneke, great to see you this morning. And look, this was your 10th consecutive quarter of growth. You beat expectations, but still it's that disruption in the facility. What exactly happened to that facility in late June, and why did that translate into about a $200 million threat for the holiday season? I think we might be pleased. There we go. Sorry, Hanneke, just your sound for a moment wasn't going. Please take it away.
All right, we're here. Great. It's great to be here. We're super pleased with the quarter we just delivered, and we can talk about that. But let me talk a little bit about the incident at one of our semiconductor suppliers that happened at the end of June. A lot is still unclear. We do believe it's absolutely temporary and ring-fenced to Q2 and Q3, but it is an important supplier. They remain closed, and we don't have a definitive reopening date. We obviously have a crack team working on mitigation plans at the moment, leveraging existing inventory, leveraging secondary suppliers, which we do have. But as you will well know, the general supply situation for semiconductors at the moment is unusually tight, and we need a lot of them, and we need them right now, hence the uncertainty in the outlook. But all that said, we're super pleased with our results, our 10th quarter of growth, also growing market shares and really great operating income growth, up 44% in the quarter versus last year, and even without the tariff refund, up 14%. So this is a company that has taken a lot of blows between tariffs, geopolitics, component shortages, and yet we continue to deliver quarter after quarter, growing the top line, growing the bottom line, growing gross margins.
Yeah, it's maybe one of the most, shall we call it, interesting times to be a CEO at a company like yours, Hanneke. So it's always so interesting to talk to you. And I know that you had mentioned earlier, kind of when all of this was brewing, the concerns over chip supply, that you had stockpiled chips. What was that case? Did you end up stockpiling chips? And do you have any left in the reserve that you can kind of tap on when you have these types of disruptions?
Absolutely. So that's the beauty of a great balance sheet. So we have more than $1.5 billion in cash, no debt. So we have been, I wouldn't call it stockpiling, but we have really healthy levels of inventory. And therefore, again, in Q2, despite the closure, temporary closure of this supplier, we think the impact in Q2 will not be very large, about 20 million. But in Q3, it might be larger. We're working on mitigation plans at the moment. And again, no better team than Team Logitech to overcome some of these issues.
Again, I know you're actively working on those mitigation plans, but how does this thing kind of work? Are you able to shift production to secondary suppliers, or is this thing like it's a proprietary chip, and so that option you can't necessarily be as nimble? How does it work with a facility like this?
Yeah, unfortunately, some of this is competitive, so I can't give you all the details, but I will say, again, for resilience, we always have multiple suppliers of different semiconductor components. That's the case in this case as well. But again, the supply is a little tight at the moment, so we're working very hard on mitigating. Demand will be there. We're creating really strong demand across our businesses. You know, mice up 14%. Who would have thunk it? Gaming up 9%, video conferencing up 9% in the quarter. So the demand is there, and our team will be doing their very best to make sure we have as much supply as we can to meet it.
What is your expectation for this holiday season when it's a consumer that still is feeling that price hike fatigue? Do you expect them to still show up, buy gaming, buy different tech from Logitech?
Yeah, we're really optimistic on gaming. So the global gaming market in the first quarter accelerated to about 7% global gaming growth. We outperformed that with 9% net sales growth, and that's really driven by innovation. You know, our new Super Strike Pro mouse is doing incredibly well, huge adoption amongst pro gamers. We also launched a really cool new gaming keyboard, the 512X, that's doing well. And then we have all these collaborations with iconic brands that just go from strength to strength. So collaborations with NASCAR, with McLaren, with the new Call of Duty. So the marketing helps elevate that performance as well. And we expect, again, that gaming demand to continue. All of this is before the launch of GTA 6 in November. So really good trends there.
There has been some stress in the gaming sector over the price of components getting more expensive, especially as we see things like RAM and memory costs grow. Just looking at some of the executive commentary, Tim Cook described it as an unprecedented challenge. We've never seen component price increases this much. Dell's chief operating officer, it's unprecedented. We have not seen costs move at the rate that we've seen. Hanneke, is that what you're seeing on your side too? Just the increase in costs is something like you haven't seen before in your tenure?
Absolutely. It is unprecedented. And that's why I'm so proud of our team. You know, our gross margins, even without the tariff refund, were up 270 basis points in Q1, almost 45% without the tariff refund. Our team is doing a great job offsetting very significant cost increases through cost reductions on other things, but also through premiumization. Again, the new Super Strike mouse, the MX Master 4 on the work side, which is also a very premium product, and then video conferencing in general, which is a premium category for us. Mix is really helping us offset and deliver fantastic gross margins.
Oh, that's interesting, Hanneke. So is the idea not to necessarily raise prices across the board, or perhaps you have, but instead to develop just more premium items that you can charge more for?
Absolutely. So we have only taken pricing on video conferencing where the memory chips have gone up a lot. So we did take some pricing there, but on the personal workspace and gaming parts of our businesses, we have not taken pricing this year. But we have come up with really unique technologies and innovations, MX Master 4, the Super Strike, that deserve higher prices. And indeed, that's how we drive mix.
Hanneke, thank you so much for joining us this morning. We appreciate your time. That's the Logitech CEO, Hanneke Faber. Now, we get more earnings after the bell, and it's going to be a big test for the AI trade. Microsoft and Meta will be reporting. Before that, though, we had SK Hynix results during the South Korea trade. That did little to ease concerns. It's down 9% over the past 2 days. Its hefty spending plans have been fueling fresh fears of AI overcapacity. Bloomberg tech editor Sarah Fryer joins us now with more. It's been already a volatile session for SK Hynix, falling and then rising depending on how we're seeing. I mean, it was a really strong quarter, but they are spending more. And I just wonder for this quarter, if that's not enough, just expectations are so incredibly sky high for these companies.
We're going to see that a lot. We're going to see a lot of companies come out with numbers that in other years would seem great, even accelerating from past quarters. But the spending is causing a lot of concern because ultimately you need to have enough of a return on the investment for that spending. And you need to consider how much of that spending is just due to the rising component costs you were mentioning, or maybe the cost of money that they have to raise to be able to afford that spending. I think when it comes to Meta and Microsoft after the bell, we may see a similar story. We might see, steady growth of the cloud business. We might see a steady advertising revenue. And then it all comes down to, is that Capex growing at an expected rate or beyond what investors were hoping to see? I think investors want to see Capex that strong because that indicates excitement about AI.
And demand.
And demand because they need to fulfill customer orders, but not without a little bit of a sign that the ROI is catching up as well.
It's just such a crazy balance, right? It's like spend, but don't spend too much and be spending on the right things. If we are hearing from memory chip makers, and part of the concern is maybe they've kind of reached their peak in how much they're charging, shouldn't that be a good thing for the hyperscalers? Because it kind of suggests, I don't know, if like 30% of their spending is going towards just DRAM being really expensive and memory being expensive, that if that is peaked, that's a good thing for them? Or, I mean, am I just trying to like assign logic to where there is none? And it's just we're trying to grasp at straws to figure out what the narrative is.
We haven't heard specific customer deals. We have heard that there are a lot more long-term agreements being signed. So that might be part of this, that a lot of the companies that have the cash now to spend for the future are signing multiple-year agreements with companies like SK Hynix to ensure that they have the supply that they need to do the build-out that they expect to build over the next few years and lock in the price. So you could be right on that front, but I do think that overall, that's not the only component that we might be worried about when it comes to supply. There's a lot of demand for even just the engineering talent, the land, the energy, the water. I mean, there's so many things that go into a data center. It all kind of has to be perfect. And the money, right? Raising the money, taking on debt. These companies that don't historically have a big history of taking on a lot of debt have started to do it. They started to do more and more complicated deals to make it sustainable. And yet the Capex is growing. Yes. So looking into next year, looking into a couple years down the road, is this sustainable? Can the market hold it? Even as we see investors today get skittish about whether this is a good idea.
True, happening in the equity market and in bond spreads are starting to widen, so interesting to keep track of. Sarah, thank you so much for joining us. That's Bloomberg's Sarah Fryer. Let's get a check on your equity markets this morning. Ahead of all of those earnings, we are down 1 1/3% for the NASDAQ after yesterday's decline. Though the S&P, it did not decline yesterday, and the equal weighted measure hit another all-time high, just to show you what the divide has been like in the poor breath in this market, or the now more positive breath, I should say. 10-year yields, those are up 2 basis points as Brent crude now above $90 a barrel, with concerns in the Middle East of escalation. Let's look at some of the single-name movers on our radar this morning. With that is Nora. Good morning, Nora.
Hey, Danny, a few stocks in focus. Let's kick things off with Humana, down more than 7% and heading for its worst day since January, spending more on medical expenses in its insurance group than Wall Street initially expected. Elsewhere, Visa, though, to the upside, the company posting better than expected profit just hours after announcing plans to cut 2,600 jobs. We're seeing shares of Visa up about 0.7% this morning. The company said it's taking more than a $560 million charge tied to the layoffs. And finally, wrapping things up with Procter & Gamble, on track for its worst day since March. The stock down about 2.7% this morning. A conservative outlook driven by U.S. consumers tightening their wallets. Second quarter results also falling short of expectations, and the company doing its best to limit some of those price hikes, but leaving it with few tools to offset rising expenses. Danny, it seems as though consumers are even pulling back on their spending, even at the grocery aisle.
All right, Nora, thank you very much for those morning movers. Coming up, China weakness knocks Hermes while Gucci boosts Kering. We take a look at the luxury retailers. That's coming up next. This is Bloomberg Open Interest. Hermes shares are trading near 3-year lows after the company's leather goods sales came up short. All of that while strong Gucci results are boosting Kering. Andrea Felstead, Bloomberg opinion columnist, joins us now. Andrea, I feel like this is the bizarro world. This is usually the opposite of what we see. I thought that Birkin bags and Kellys were supposed to be acyclical, that no matter what happened, they were a luxury good that people would spend more for. So what went wrong?
That's exactly the case, that we did think they were like that. Unfortunately, Hermes has been shown to be a bit more vulnerable to the same factors as the rest of the luxury industry. And China has stabilized, but the company said today that it's not improving, and that has really spooked investors, even though that's not much different from what everyone else was saying.
What changed with the consumer then, Andrea?
Well, the Chinese consumer has been in a bit of a slump for the last few years, and there have been signs that it is improving. Their appetite for luxury goods is improving, but it's not yet coming back, significantly, and it's a big driver. In the meantime, the US shopper is doing very well. That's made up for that weakness in China. But Hermes has traditionally been a very highly rated stock, so any weakness has been felt.
So on the other side of things, the luxury goods company that seemed like it had been stumbling is now all of a sudden posting results stronger than expected. We had Kering earnings being supported by Gucci. What's changed at Gucci to allow this to happen?
Gucci is still going backwards, but it's not going backwards quite as much. And the result, the sales were better than expected. So that has given investors some confidence that Gucci's turnaround is working. And Gucci's very important for Kering. At its peak, it accounted for about half of sales and about 2/3 of operating profits. It's really the biggest driver, and it's got a new designer, Demna. The response to his collections have really been very mixed, but Kering said that the handbags, which are the real drivers of profitability, were doing well, and this has been taken as a sign that Gucci is on the right track.
Even so, is this just a sector which is mired in something of a slump at the moment? LVMH earnings also earlier this week, not exactly a standout.
Exactly. There's a few factors going on. As I mentioned, the US is doing really well. Until recently, at least, stock market AI wealth was really bolstering spending power. But it seems that shoppers that when wealth is created, they want to treat themselves on something different, like jewellery or watches rather than handbags. So that's really been the big difference. Then you've got the geography. You've got the US doing well. South Korea's been doing well. Japan. But China's still not come back. And that's really what you need for the next leg of the recovery.
Andrea, thank you so much for joining us this morning. Andrea Felstead of Bloomberg Opinion, who's been writing some really excellent pieces during this earnings season, including on LVMH and Arnault and succession talk. Coming up, BMW joins a growing list of European automakers cutting costs. That's coming up next. This is Bloomberg Open Interest. This one's for you, Matt Miller, if you happen to be watching at home from paternity leave right now. BMW offering voluntary severance packages to thousands of workers as it looks to cut about 8,000 jobs globally. The move comes as Europe's automakers slash costs amid weaker demand in China and mounting competition from Chinese EV makers. Craig Trudell, Bloomberg's managing editor for global business coverage, joins us now. A taste of it there in terms of what woes BMW at the moment, but what are sort of the big factors that have caused them to undergo this cost-cutting effort?
Yeah, I think this is a company that has actually sort of long been reputed among the major German manufacturers as sort of the best operator, the one that actually has the most discipline, tends to avoid big mistakes. So for them to make this move is actually fascinating just in that context. But it's pretty consistent with some of their peers in that there's been significant underperformance across Volkswagen, Mercedes, and now BMW in China. where that is such a crowded market with so much competition that it's been more and more difficult for some of these companies that are positioned at the high end of the market to really justify continuing to price for their vehicles when there are so many players who are sort of trying to move up market because of the fact that sort of the getting is so difficult.
So what distinguishes then between car companies that have premium offerings that are doing well and ones that aren't? Because Porsche has earnings, and their 911 helped carry them despite weakness everywhere. Ford reports earnings this morning too, and it's their expensive SUVs that are helping to support them. So is it just as simple as if Americans like it and Americans are spending, it's okay, but if you're relying on China, it's no good?
It helps. I mean, this market is, it's smaller than China in terms of volume, but the value is so strong. The fact that we do have protection against those Chinese manufacturers has made this a sort of bastion market. So you do still have people buying lots of 911s. You have people buying big SUVs. So we have, the announcement just today as well that Audi is bringing out its latest and greatest vehicle, and it happens to be a sort of Cadillac Escalade fighter. This is the market that is quite healthy and quite strong in terms of the K-shaped economy and wealthy consumers going out and buying new vehicles. And we're seeing that in terms of in Porsche's results. But again, the German manufacturers here, they're really squeezed because you mentioned 911. Those are all tariffed, right? So these manufacturers are getting hit not just by the China slowdown, but by the fact that the Chinese are growing so much in their home market, and they're only able to so take advantage of the U.S. market because of the trade tensions between us and Berlin.
Yeah, Craig, before we let you go, I remember when the Ferrari Luce came out, you had been very clear to say, look, it's ugly and it doesn't matter. And that was right on the money because the FT out with a story saying that they've hit their 2026 targets for sales of Luces. So, I mean, is that your read that maybe people were just like, yeah, this thing's ugly, but I still want one?
I think our colleagues in Italy have done such great work on this notion that the way Ferrari works, sort of if you want your sort of choicest model, you have to kind of work with the manufacturer a little bit and sort of put down a few €100,000 toward a vehicle that maybe you care a little less about, but to stay high on the order list or the wish list for the sort of V12 or V10. You may have to sort of take delivery of this electric vehicle that some people think looks a lot like a Nissan Leaf.
Right. And Nissan is all of a sudden like, we've seen that before. Ferrari doesn't publicly disclose its targets, though. I mean, again, from what the FT is reporting, I guess about 500 units. What does that look like in the context of Ferrari's business?
I think that's important here for us to keep in mind that maybe the bar was set a little bit low for this model, because even for Ferrari, which has always been sort of value over volume, this is a pretty small model in terms of importance, where increasingly the SUV that they've brought out in the last few years has been where they've done the most of their volume. And for a manufacturer that on a normal year does sort of 12,000 to 14,000 roughly vehicles a year, 500 even is pretty small.
All right, Craig, thank you so much. That's Bloomberg's Craig Trudell. And by the way, he might not be on this show because of his paternity leave, but Matt is still doing his podcast, Hot Pursuit with Hannah Elliott. Give that a listen if you miss Matt, as I do, wherever you get your podcasts. And I'm not going anywhere. Catch me on Bloomberg Deals today and every Wednesday at 12 p.m. New York time. And tomorrow on Open Interest, Anastasia Amoroso, Starbucks' CEO, and Joanne Feeney of Advisors Capital. This is Bloomberg.